Welcome back to the deep dive. Today we're taking on a source topic that's, well, absolutely critical for understanding how companies really perform. But it often feels like the most opaque part of the financial statements, taxation. We're diving deep into Chapter 13, all about accounting for income taxes.
Yeah, it's true. Most people, when they look at accounts, they focus right on the cash tax bill. What do they actually pay the government this year?
That's current tax, right?
Exactly, just current tax. But under the global rules, IAS 12 income taxes, there's more to it. Entities have to recognize two elements of tax.
Two.
Yeah, the immediate liability, the current stuff, and then the long-term view, the future consequences.
That distinction, the snapshot versus the forecast, that's really key here, isn't it?
It is.
So our mission today is basically to give you the shortcut, the roadmap, to understanding how companies account for tax. Not just what they pay now, but what they might owe, or maybe even save years down the line.
And it's more than just ticking boxes for compliance.
Right. It's about truly forecasting the cost of doing business, yeah.
Precisely. We're using IAS 12 as our blueprint here. It basically forces companies to match the total tax effect of something back to the period when the transaction actually happened in the books.
Which makes sense.
Because if you only looked at the cash going to the tax authority each year, you'd constantly be misleading investors about the underlying profit.
Okay, let's unpack this then. We should probably start with the simpler bit first. Current tax.
Right. Current tax is the basic entry. It's the tax you expect to pay or maybe get back for this specific reporting period.
And it's based on the taxable profit or loss, the number the government cares about.
Exactly. Calculated using their rules, which, crucially, often differ from standard accounting rules. And here's the first little complication. At the date the financial statements actually come out, this figure is usually still just an estimate. The final number isn't agreed yet.
Okay. But the accounting for it, the mechanics, seem clean enough on paper. You debit the income tax expense. That hits the profit or loss statement.
Correct.
And you credit income tax payable. That sits on the balance sheet, the statement of financial position, as a current liability.
Yep. And that liability on the SFP, it only reflects the estimate for this specific period we're reporting on.
Got it. But you said estimate. So what happens when last year's estimate turns out to be wrong? Which must happen all the time.
It does. And that's where we get into under or over provisions. IAS 12 is quite specific here. Any difference between what you estimated last year and what you actually settled with the tax man.
Yeah.
That adjustment has to be dealt with in the current year's profit or loss.
Wait, really? You adjust this year's profit for last year's error? Doesn't that sort of muddy the waters for comparing year-on-year performance? Seems a bit lacking in transparency.
It's a fair point, and it does raise questions about presentation. But the thinking is, well, the prior year's books are closed, they're audited. This adjustment reflects a correction that impacts cash flow now.
Okay, so it flows through the current expense calculation.
Exactly. So if you underprovided last year, you didn't set aside enough cash, then you have to increase this year's tax charge.
Which makes this year's profit look worse. You expense the difference.
Right, you're settling an unexpected bill now. And the flip side, if you overprovided, set aside too much.
You decrease the current tax charge, like a credit to the P&L.
Precisely. It boosts the current profit. It's a necessary cleanup. Like you said, it's definitely a detail investors need to keep an eye on.
Okay, so that covers the immediate tax, the current stuff. Now,
Yeah.
the big one, deferred tax. If current tax is all about what the tax authorities calculate, why on earth do we need this whole other layer of tax reporting looking into the future?
What's fascinating here is it really gets to a fundamental disconnect, a split almost in corporate reporting. Well, the accounting profit, that's the number that drives dividends, share price, what you report to shareholders. It's almost never the same as the taxable profit, the number the tax authority uses to calculate your bill.
Okay.
And deferred tax is the mechanism, the tool needed to properly allocate the total tax charge to the right accounting periods. It ensures that when you report, say, $1 of profit to shareholders, you're also matching it with the eventual tax cost of earning that dollar, even if you don't pay that tax today.
Right, matching principle. So this disconnect, this gap between accounting profit and taxable profit, it gives rise to two kinds of differences.
That's right. First, you have permanent differences. These are pretty straightforward.
Okay.
Think of things like, say, fines or maybe certain entertainment expenses. They might reduce your accounting profit.
But the taxman says, nope, no deduction for that.
Exactly. It's allowed in the accounts, but permanently disallowed for tax.
Yeah.
And because that difference will never reverse itself.
It has no impact on deferred tax.
Got it. Correct. So the real focus, the whole point of IAS 12 really, is on the second type, temporary differences.
And these do reverse.
Yes,
Yeah.
eventually. They're all about timing. They arise purely because there's a difference between an asset or liability's value in the account's, what we call its carrying amount, and its value for tax purposes. It's tax-based.
The classic example everyone uses is depreciation, right?
It's perfect. Companies often use faster, accelerated depreciation for tax, right? To get bigger tax deductions sooner, lowering their current tax bill.
It makes sense from a cash flow perspective.
But for their financial reports to shareholders, they might use the slower, straight-line method. Makes the accounting profit look smoother, more stable year to year.
So you get this gap opening up.
Exactly. You've taken the tax break faster than you've recognized the expense in your accounts. You've essentially, borrowed a tax deduction from the future.
And if you just stop there with the low current tax expense,
Your current profit looks artificially high. You've inflated it.
so the deferred tax calculation is the adjustment needed to smooth that out, to make sure the total tax expense current plus this deferred bit actually matches the profit you're telling shareholders you made.
Precisely. And if you don't do that smoothing, the source material is very clear. You immediately overstate profits.
And that's serious, because that distortion messes up key metrics like earnings per share, EPS.
Absolutely. Which directly misleads shareholders, potentially affects the share price, skews how people value the company.
Okay, that really drives home why it's so critical. So how does IAS 12 tell us to actually account for this? What's the rule?
The fundamental principle in IAS 12 is pretty robust. It says an entity must recognize a deferred tax liability or maybe an asset whenever recovering an asset or settling a liability in the future.
Yeah.
Will make future tax payments either larger or smaller than they would have been otherwise. You're essentially putting an entry on the balance sheet today for a tax event that happens later.
Okay. And the calculation itself, once you found that temporary difference.
It's conceptually simple. Deferred tax equals the temporary difference multiplied by the relevant tax rate.
Right. So let's look at the two possible outcomes, starting with the less good news. Deferred tax liabilities, DTLs.
DTLs. You recognize these for all taxable temporary differences. These mean you'll pay more tax in the future.
Why did that happen?
Typically, it's when an asset's carrying amount, its value on your books is higher than its tax base. You've recognized more value or income now than the tax authority has, so the tax related to that extra bit has to be paid later.
Okay. Then the flip side, the potentially good news. Deferred tax assets, DTAs.
Right, DTAs. These are recognized for deductible temporary differences. They represent future tax savings. Your future tax payments will be lower.
Can you give us that warranty example again, just making it super clear on carrying amount versus tax base?
Sure, think about a warranty provision. When a company sells something with a warranty, accounting rules say, recognize the estimated future cost and the liability right now.
So the carrying amount of that liability is the full estimate.
Yes, but the tax authority, they usually only allow the tax deduction when the company actually pays out on a warranty claim.
So until those claims are paid, the tax base of that liability is zero.
Exactly, so you have this difference. The carrying amount, which is the full estimated cost, minus the tax base, which is zero. That's a deductible temporary difference.
Meaning you'll get a tax break later when you settle those claims. That creates the DTA.
Precisely. A future tax saving book today, but, and this is a huge but.
Oh, there's always a catch.
There is. You can't just recognize these DTAs willy-nilly, hoping for the best. IAS 12 puts a major restriction on them.
Which is?
You can only recognize a DTA to the extent that it is probable, that's the key word, probable, that you'll actually have enough taxable profit in the future to use that deduction against.
Probable. That sounds subjective.
It is hugely subjective. Management basically has to gaze into a crystal ball, project future profits, sometimes for years out, just to justify putting this asset on the balance sheet today.
Wow. And what if they're too optimistic? What if they get that judgment wrong?
That's where things can unravel. If they recognize a DTA banking on future profits that just don't materialize,
Yeah.
then eventually that DTA has to be written down, impaired, and that write-down hits the profit and loss statement later on.
So you get this unexpected hit to earnings just when maybe the market thought there was a tax asset coming.
Exactly. It's why analysts spend so much time scrutinizing DTA balances and the assumptions behind them. It's a real pressure point between management optimism and accounting conservatism.
Okay, here's where it gets really interesting.
Yeah.
Let's talk about some specific, maybe less common situations, like using past tax losses. That can create a DTA.
Yes, tax losses often can be carried forward to offset future taxable profits. That potential future offset is effectively a deductible temporary difference, hence a DTA.
But that probable test must be really tough here.
Extremely tough, especially if the company has a history of making losses. How can you argue it's probable you'll make future profits if you consistently haven't in the past?
Good point.
You need strong, verifiable evidence. Maybe they're part of a larger, profitable group that can absorb the losses, or they have a really solid, detailed turnaround plan with binding contracts already in place. Just hoping things will get better isn't enough.
Right. Wishful thinking doesn't cut it. Okay, what about something else quite common now? Asset revaluations. Say a company revalues its land or buildings upwards to fair value. Big gain on the books.
That's another critical area for deferred tax. When you revalue that asset upwards, its carrying amount in the accounts shoots up.
But its tax base probably stays the same, right? Still based on the original cost for tax purposes.
Usually, yes. So boom, you instantly create this big difference, carrying amount way higher than the tax base. That's a taxable temporary difference.
Meaning more tax to pay later when the asset is eventually sold or used up.
Correct. So IAS 12 says you must recognize a deferred tax liability, a DTL, for that difference, right, when you do the revaluation.
But wait, that revaluation gain itself, the big uplift in value, it doesn't usually go through the normal profit and loss statement, does it? It goes to other comprehensive income, OCI, and sits in that revaluation surplus account in equity.
Exactly right.
So where does the tax expense for the DTL go? Does that hit the main P&L?
No, and this is a really neat, crucial point about matching. Because the gain that created the temporary difference went to OCI.
The related deferred tax expense also has to go to OCI.
Precisely. It gets charged against the revaluation surplus. It bypasses the main profit or loss statement entirely.
Why?
Because putting it through the P&L would distort your operating results for the year. The tax follows the gain. It ensures the tax consequence is recognized in the same part of the financial statements as the economic event that caused it. It keeps things consistent.
Okay, that makes sense. It preserves that matching principle even across different parts of the performance statements.
It does.
So let's pull this all together then. What does this all mean for you, the listener? This deep dive, I think, really shows that the income tax expense line you see on a company's P&L, it's not simple. It's a complex, layered number.
Yeah, it's a blend, isn't it? It mixes the immediate estimate, the current tax, with this longer-term, highly judgmental forecast, the deferred tax.
We've gone from thinking about just an estimated current liability
to projecting future tax consequences, sometimes years out. And the whole engine driving that projection is tracking those temporary differences.
those inevitable gaps that open up simply because accountants and tax authorities use different rule books for the same things.
Rules that have to reconcile in the long run.
And the absolute core takeaway, the driver for all this calculation, is really that simple sounding difference. Carrying amount versus tax base, that temporary difference.
That differential tells a huge story. It's a critical forecast of the company's long-term tax position, revealing the true eventual cost of the accounting and tax choices they're making today.
It forces a certain transparency, doesn't it? Pushing companies beyond just looking at immediate cash flow savings from things like quick tax depreciation.
And towards presenting a more consistent, sustainable picture of their earnings over time.
Which leaves us with a final provocative thought for you to mull over. If a really key indicator of shareholder value, something like earnings per share, can be so fundamentally distorted if you ignore these long-term tax impacts hidden in temporary differences,
Yeah.
what other, maybe seemingly small accounting conventions, like that probable test for recognizing an asset, are quietly shaping how we all perceive a company's financial health? That's perhaps a deep dive for another day.